T-minus 5, 4, 3, 2, 1. Live from Studio One here at Bloomberg headquarters in New York. I'm Romaine Bostic, and Alex, you look so far away.
You are so far away. Like, you're right here, but you're so far. I'm Alex Steele. We're kicking off to the closing bell right here in the U.S. on this sleepy Tuesday after Memorial Day weekend. So you did have record highs on the NASDAQ 100 and the NASDAQ kind of coming off those levels right now. The S&P is up by 0.2%. But NVIDIA did hit a record high, and that really helped the outperformance of tech. I just want to point out the bond market here, yields moving higher. You got an auction in the 2 and the 5. You get over $40 billion worth of the 7 coming tomorrow. So watching that space. And dollar yen, Romaine, the yen is back to talking about it. It's back to being low. You had the pound, for example, pound yen hit that highest level in 16 years. We're still watching. We're still waiting for that yen to find some stability.
Alex, you know how much I care about the yen.
Do.
Thanks for including that. We should point out this is going to be a potentially busy day, potentially busy week for traders, or at least for the clearing houses that settle transactions. That new T1 rule goes into effect today. It is in effect, meaning anyone buying a U.S. stock has 1 day to deliver the money, while anyone selling has 1 day to supply the shares. Now, that's part, of course, of a years-long evolution from what was 5-day settlement back in the 1990s. Now, the most noticeable effect you're going to see is going to be investors just getting their proceeds on their transactions in hours, and brokers getting lower margin requirements, which, well, with default lessened, that should make sense. But as far as market volume or pricing today, this shouldn't have a huge effect, though do keep an eye on some of those glitches. A spike in failed trades, that is among the industry fears out there right now. Now, the question, though, is how large and persistent that spike might be. JP Morgan says about a quarter of the currency trades it processes will be affected. Brown Brothers Harriman put clients through a T+1 simulator to identify potential issues. And then you have SocGen, Citigroup, HSBC, UBS, just among some of the banks saying that they've either moved staff, reorganized shifts, or built new systems to prepare for the change. 2 big stress tests do come this week. That includes on Wednesday, tomorrow, with the double settlement day, and on Friday, when the MSCI rebalances its indices. Now, the Foreign Exchange Professionals Association is telling people to prepare for acute spikes in volatility and price spreads at month's end and around national holidays. But for now, it is worth noting, Alex, that volatility does remain subdued, and based on option selling, volatility likely isn't going anywhere for now. The army of volatility sellers is continuing to swell in size, Alex.
Yeah, and you can really see that reflected, Romaine, in a very simple function, CCRV. It tracks the curve of the VIX. So I took a look at 1 month and then the price today. So the top line, that green line, is where the VIX was a month ago, and the orange line is where it is now. And you can really wind up seeing the spike and vol around the election, but I say spike with quotations because we barely wind up hit 20, but how the whole curve has really come lower by a few points there. It remains to be seen. Okay, volatility moves a little bit higher, but we are still modestly subdued, at least for the next year.
All right, let's kick things off here with Mandy Xu, head of derivatives market intelligence over at Cboe. Mandy, great to have you here.
Thanks, Romaine. Great to be here.
I think if there's anybody who knows what's going on in the options market and what's going on with volatility, it's you. Kind of explain this to us, because we've been talking about low volatility for a while. And I don't know if that's directly tied to what's happening today or whether that really is a look ahead to the elections and the uncertainty around it.
I would say the low levels of the VIX right now is more a reflection of what is going on right now. Keep in mind the VIX obviously is a very short-dated measure of volatility, being 30 days forward looking for the S&P. So right now the VIX level today is not going to reflect the election fear. But as Alex just pointed out, if you look further out in the VIX futures curve, that is certainly one of the fears, one of the catalysts that is being embedded in the volatility curve. But I would say, in terms of why volatility is low, it's largely on the back of positive macroeconomic fundamentals and the Fed really taking the wind out of the sails of the volatility markets with their last meeting, and kind of the patience that they have expressed with, willing to wait for inflation to reach their target.
Are there any signs that volatility could pick up? Let's take the election out of the equation, because it's interesting you say the Fed has kind of calmed the markets. They have, but of course the Fed's got a lot of unresolved business too, and you kind of wonder what's going to happen over the next couple of Fed meetings as they try to start communicating whether they're going to cut rates or maybe even hike.
Correct. Absolutely. I think the consensus expectations around the path of interest rate can and may well shift as we go throughout the year. But I don't see it at this point as being a volatility catalyst, right? Because at this point, kind of sticky inflation and the Fed is very much a well understood risk. What tends to really drive volatility higher or significantly higher tends to be what I call the unknown unknowns, whether that's geopolitical. We saw in April, kind of the big VIX spike really came on the back of the Iran-Israel potential escalation. So to me, the path of interest rates, there's still a lot of uncertainty around it, but I don't see as really being a driver of significantly higher equity vol, at least without something materially shifting.
And then you have like the day-to-day options, right? And that's really just put a crimp under the overall volatility level, right?
So that's debatable whether
Some might say that.
So some might say that the 0-day to expiry options are what is driving the low volatility. I would take the other view for a couple reasons. One is that the activity that we see within 0-day options is actually very balanced. So it's not predominantly vol selling, which is suppressing volatility. And the second is that if you look at the low volatility that we're seeing, we're seeing across asset classes where there are no 0 DTE options being traded, right? Credit volatility. One thing I think it's worth highlighting, our credit VIX index, VIX IG index actually hit an all-time low earlier last week. So credit volatility, FX volatility, rates volatility, commodity volatility across every asset class is low. And that to me goes back to the macro fundamentals. It's the fact that we are, at least appear to be, still firmly on track for a soft landing.
So when you take a look at, say, then where the hedges are. So what has changed now, say, versus a couple months ago? Like when we see is there demand for upside hedging or is it downside hedging? Like where are you seeing the differences?
Sure. Yeah, that's a great question. So I would say, at the beginning of the year, the risk that option traders were still predominantly focused or worried about was still upside risk. So we saw a lot of demand for those upside calls. We saw that all through Q4 last year, carry through to the first quarter of this year. Standing here now, though, we're actually starting to see a meaningful pickup in demand for downside put options in, like, say, S&P. So S&P measures a skew, so that demand for downside puts versus calls has really picked up in recent days. And I think it's a function of the fact that, we're at all-time highs in the market, volatility levels back down to multi-year lows, so people kind of opportunistically adding hedges at this point in the market.
How does that sort of overlay, though, with this idea of what's happening overseas or maybe what's not happening overseas? We've seen a lot of activity in the FX space. We've seen a boost in the carry trades and a lot of concerns that on Fed policy as well as economic conditions, we're kind of diverging in terms of on a country by country, market by market basis.
True. I think there's definitely, a lot of talk about policy divergence, and that's probably one of the reasons why FX volatility did experience an uptick, earlier this year. But for equity markets, it's really the risk that they're most sensitive to is still the economic growth risks, right? And within the U.S. is still strong. I think that explains why VIX is still low. But even if you look at volatility indicators for other regions, for example, the MSCI EAFE index or EEM, emerging markets, volatility is low across regions. And I think that's really a fact of, that global growth still to this day remains fairly robust.
That makes me so nervous. Like we joke that I'll put gold bars under my bed, but I got money in a money market fund. That makes me nervous. And everything seems chill. That's when I get worried. So
maybe to calm that fear, or to as indicative of that fear, what I think is interesting is that we are seeing record volume in VIX options, particularly demand for VIX upside calls. So I think that is a sign that people are getting a little bit nervous and are opportunistically adding some VIX upside hedges given where VIX levels are. But that to me is a sign of, you're worried about the unknown, the black swan event. You buy VIX options not to hedge marginally higher interest rates. You buy VIX options really to hedge that big shock to the market, whether that's geopolitical or another catalyst.
All right, Mandy, always so smart. Always great to have you. Wonderful way to kick us off to the close here on this Tuesday afternoon. Mandy Xu, head of derivatives market intelligence over at Cboe. When we come back after the break, a closer look at that new T1 settlement rules taking effect today. Ken Bentsen, president and CEO of SIFMA, going to be stopping by to offer his insights on a big change for the industry.
Plus, our stock of the hour is Celsius, why the energy drink maker shares are in a deep freeze.
And as U.S. earnings season winds down, eyes are now back on the Fed. Katrina Dudley, portfolio manager and investment strategist at Franklin Mutual Series, has some thoughts on that. We're going to talk to her in just a bit, right here on The Close on Bloomberg.
South Africa's most important election since the end of apartheid focuses on infrastructure challenges, economic growth, and political fragmentation. Bloomberg's Jennifer Zabasaja reports live from key battlegrounds in Johannesburg, Cape Town, and Durban.
We think that South Africa is an exciting part of the world.
South Africa is a thriving and vibrant democracy.
There's a lot of expectation for the election.
Continuing coverage today on Bloomberg Television. Context changes everything.
To some deals news of the day. It's not Merger Monday, but hey, but Merger Tuesday. You got T-Mobile buying U.S. Cellular's wireless operations for about 30% of Spectrum assets for about $2.4 billion. Joining us now from more is Bloomberg's Jess Menton. Jess, this is just basically all like, let's just buy up as much towers as we can.
That's pretty much what it is, to your point, Alex, because so T-Mobile is the second largest mobile carrier behind AT&T in the U.S. And so if you remember a couple years ago, whenever it did have that merger with Sprint, I was one of those customers that actually got grandfathered into T-Mobile. But it's been trying to expand its presence really to rival some of when you are thinking about AT&T or Verizon here. So this is another step toward that. If you look at U.S. Cellular stock, USM is the ticker symbol on this, up about 8% this morning heading into the closing bell. So that's its best day since May 9th. But if you look over at T-Mobile, TMUS is the ticker symbol, only up about 0.4%. If you look at year to date, that stock's up about 3%. If you look over at its rival AT&T, though, that stock's just marginally lower for the year. But this is an effort to really expand its presence, to take another step forward to try to compete with its bigger rivals.
Is there any concern here about them sort of using up their cash for this? I mean, the shares aren't down. I mean, they're only up fractionally, but are investors concerned?
Well, part of that is also $2 billion in debt that they're going to take on. So it's not just cash that they're using for this. So that is something there. But actually, John Butler, who is an analyst at Bloomberg Intelligence, he put out his research today, who tracks that company as well as those other wireless carriers. And they really feel like this deal will accelerate its presence when you are thinking about T-Mobile, and then especially from an earnings perspective moving forward, because what that means really for 5G and some of these carriers. So if you're looking at this, especially when it comes to its presence as far as what it means for 4,400 telecom towers, it also has a longer-term tenant, at least on 2,600 towers for U.S. Cellular there. So that's something that even when you are thinking from an earnings perspective, Bloomberg Intelligence still sees this as a positive for this stock.
Well, yeah, and basically, like, if you look at cellular towers are like prime real estate at the end of the day, right?
Right.
It's really hard to build them, and
it is.
You really have to buy the ones that are available, and
That's right.
Therefore, it's kind of maybe worth the debt from that perspective because there's only so many of them.
And not just when we are talking about T-Mobile, but the Wall Street Journal had reported earlier this month that Verizon was also looking to buy up particular parts of U.S. Cellular too, but this could potentially take a little bit longer. So it's not just a T-Mobile story for this too.
Is there any antitrust issues here? Because I mean,
always the million-dollar question, right?
But I mean, I hear about all these towers being bought, and then
That's right.
Didn't they buy Mint Mobile or something?
Yes,
right?
they did.
All right, so I mean, I feel like it's great for them,
right?
But I mean, I don't know. You've seen the folks in Washington these days; they don't seem to like anything.
No, they don't. It's so much disagreement when it comes to
Yeah.
Capitol Hill. So this deal is actually supposed to close in the middle of next year. As far as now, it seems like this could potentially most likely go through. It doesn't seem like there'll be a lot of pushback from the regulator side, at least from our research with Bloomberg Intelligence. But of course, that remains to be seen, as we do see a lot of deals like this happen, and we could still have to wait and see what happens when it comes to Washington. But as far as now, it seems like there aren't any major obstacles in front of this deal.
All right, Jess Menton there with Bloomberg News. A closer look at shares of T-Mobile and U.S. Cellular, brokering a pretty good deal. U.S. Cellular having a pretty good day, Alex. And there are a couple other big stories that have also been floating around here on the market. I know you're really into the energy space, and everyone was keeping an eye on that Hess merger. Shareholders finally signing off on it.
Yeah, and that was actually maybe not surprising, but a big deal because there were a couple big shareholders that were recommending to abstain because there was an arbitration suit between Chevron and Exxon over Hess and its portion of Guyana off the coast of South America. So it wasn't like a sure thing at the end of the day. And if it failed, that would have been something.
So now that it's approved, or at least shareholders have approved it. Okay, where do we stand now?
I don't know. Lots of the lawyers. This is arbitration.
Do you not have Lena Khan's number or whoever's in charge down there?
No, it's not even. We're not even at the FTC level. This is now purely in the courts with arbitration between Exxon and Chevron because Exxon thinks they have the right of first refusal to this, even though Chevron's buying the whole company and not just the asset in Guyana, with which Exxon owns 45%.
So this isn't a regulatory issue at this point. It's just basically getting through the legal issues.
Yep. And then if there is an FTC issue, then that's a different story that they have to tackle. But it's the arbitration case, which is part of the reason why the shareholders wanted to abstain because they're like, there's way too much risk here right now.
All right. Well, you know who wins in all this?
Lawyers.
The lawyers.
Bill and
exactly. All right. Coming up here, Raymond James says launching into new markets isn't boding well for the discount airline Frontier Group. We're going to talk to her in just a second. Coming up in our top calls right here on The Close on Bloomberg. All right, it's time now for our top calls. This is where we take a look at some of the big movers on the back of analyst recommendations. And we start off with On Holding, the maker of those popular running shoes and other athletic apparel, getting an upgrade to buy from hold. This over at Truist, with Truist citing growth opportunities from discretionary spending and consumer pullback from brands like Nike. The analysts also see opportunity from the growing popularity of tennis apparel. Shares of On Holdings having a decent day, up about 3.5%. Norwegian Cruise Lines is up next, and they got an upgrade today as well to buy from neutral over at Mizuho for what the analyst says is an attractive valuation and a positive industry backdrop of limited supply and healthy demand. The analyst also cites a shift in investor sentiment and expects cost-cutting efforts to drive greater than anticipated operating leverage. Those shares in Norwegian Cruise up about 3% on the day. And finally, let's take a look at Frontier Airlines. The discount carrier getting downgraded today from an outperform rating down to market perform over at Raymond James. Frontier's moves to launch in new markets and diversify price offerings, well, that's coming alongside some near-term downside risk to earnings. That's according to the analyst, and she also cites long-term concerns after Frontier nixed late fees for changes and cancellation fees, which accounted for about 8% of its revenue last year. Shares of Frontier down more than 9% on the day. And those are some of our top calls. We do want to stick, though, with that last call on Frontier, because I'm pleased to say that the analyst behind it joins us right now. Savanthi Syth is managing director over at Raymond James. And Savi, let's get right to it here. Frontier has been facing a lot of challenges over the last few months, really over the last couple of years here. What really prompted you to make that downgrade today?
I think Frontier is doing some interesting changes to their network, to their kind of pricing structure and the markets that they fly into. All of this is very good and changes that they need to make. I think they'll be successful in the middle on the longer term. However, it is causing 2024 probably to be a investment year. And even the kind of the loss of change fees and cancellation fees should be overwhelmed by other revenues, but it will take time. So we're concerned about the near term. Also, some of the changes that they're making for the network to improve the operations. We're not seeing it in the results yet, so that kind of gives us pause heading into the strong summer season.
Well, what does that mean then, Savi, when we talk about just kind of the stability of these discount carriers? We've seen other carriers, including Southwest and a few other discount carriers, kind of expand in a lot of ways, expand with more fees, expand with different routes, try to find something to sort of differentiate themselves, and some are even just raising prices. Is there a future for the business model of being a pure discount airline?
I think there is. Right now, you definitely have a strong kind of long-haul international demand. You have corporate recovery, leisure, maybe not as strong, domestic leisure, maybe not as strong as some of those areas. I think one of the issues is that some of these low-cost and ultra-low-cost carriers added a lot of capacity, or at least a lot, to their fleets. And they were anticipating, the pandemic to be more of a normal downturn. And I think kind of given the level of cost inflation that we've seen, they need to be smaller than they had planned to. And so that's the transition I think a lot of these airlines are going through. And I suspect they'll be successful, but it will take time to adjust.
Savi, if I take a look at your price call, is $8, but the stock is trading with a 5 handle right now. So do you think the market is really underestimating or beating up the stock unfairly?
Yeah, so our price target was the kind of the earlier price target. We've taken numbers and mostly there. We don't have target prices for our market perform rated names. This is not a valuation call. I think there's probably upside to the shares just based on valuation. But in terms of earnings risk and therefore, the way the shares will really react, I suspect there's a little bit more earnings risk versus some of the other airlines heading into the summer.
That's what I was going to say. How much of it is going to be the macro conversation and how much of it is a Frontier execution issue?
Our call is on the Frontier execution issue. again, the macro seems to be holding. There's obviously signs that the consumer is showing some resistance. So the demand is strong, but maybe a little bit more price sensitivity, especially in the off-peak period. So the peak period demand is really strong. You're seeing record numbers flying during the holidays. So the macro seems to be holding, though there is a little bit of softness. And this is really more of a frontier execution call in the kind of the next 6 to 12 months.
When you sort of look at the broader though space here, I mean, you say demand is holding up here. Frontier obviously specializes a little bit more in just, consumer travel, or I should say leisure travel, if you will. I'm curious about business travel, and I know that's not really hugely a bread and butter position for Frontier, but when you look at some of their competitors that are a little bit more dependent on that, have we seen enough of a rebound in that space to see material impact on the bottom line?
Yeah, I think you're seeing some of the last holdouts starting to come back in travel, most notably tech. And so we are seeing some really good recovery there, especially in the last, since the beginning of the year. Now, business demand is probably back close to where it was in 2019. If this was kind of a normal and you didn't have the pandemic, I think you'd be much higher than that. So getting back to 2019 is not great, but it is showing some strength and some recovery. In contrast to leisure demand that's maybe more stable.
Just one quick one before we go. Do you expect consolidation with the smaller discount carriers?
I think that's the right answer for Spirit and would be good for Frontier. If Spirit can go to their creditors and clean up their balance sheet in agreement with their creditors, I think a merger with Frontier would be good for consumers. It would be good for the airline and its employees. So I think that's the longer term a good solution. Just we'll see if this administration will go for it.
Yeah, totally. All right, Savi, thanks a lot. Savanthi Syth over at Raymond James. We appreciate that today. And back to your FTC question. I mean, we saw what happened with JetBlue, right? I mean, this might not be the friendliest environment for these discounters to get together, but maybe after November, maybe a different story.
Yeah, I can't remember who we were talking to a couple of weeks on this show and said that when it comes to M&A, in the old days, the first person you call was your investment banker. And now the first person you call right now are your lawyers and your head of regulatory affairs to see if it can even get done.
There was a conversation that I had in the oil patch a few months ago that you might not think the deal gets done now, but get in the queue. Yes. Because the queue is going to get really long come November or come December, no matter who's in the White House. So get in there now, even though you're going to hit hurdles, because otherwise you're going to be in the back of the line.
Yeah, well said there.
Yeah. All right. Well, coming up, we're going to talk about our favorite topic of the day.
What's
T
that?
plus 1 plus 2 plus 3 plus 4. Kenneth Bentsen, President and CEO of SIFMA. His insight on Wall Street's return to one-day settlements, how it's going to affect the market. How do we do today? This is The Close on Bloomberg.
Just about 3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Alex Steele. And I'm looking at a market that did make record highs. We're looking at the NASDAQ 100 and the NASDAQ, but volume is still really light. It's going to be hard to find a catalyst. I know we have PCE on Friday, but come on. Is that really going to be a market mover?
Well, it depends, but I agree. I mean, we're kind of in that kind of weird netherworld where earnings season is over. The Fed, at least for right now, is about to sort of shut its mouth. Is that right?
Almost. The blackout that Carol Massar keeps talking about. Yeah, something like that.
So,
there's a few more days.
Almost there.
We're almost there until we don't hear from them anymore. So we have to wait then for jobs at the end of the day. Something that did happen today is something that happened 100 years ago.
Yeah.
The stock market.
I know. Everything old is new again.
That's exactly. That's why I shouldn't have thrown out those old jeans. And that's because trades are now going to settle in just one day. So the settlement times rose as high as 5 days back in the 70s and 80s. More recently, it's been 2 days. And the new system is known as T+1. It's intended to reduce risk in the financial system. Joining us now for more is Ken Bentsen, President and CEO of SIFMA. He's also co-chair of the British American Finance Alliance and a former U.S. congressman from Texas. Can you just explain to us why this was such a big deal and why we had to go to settle trades in just one day?
Well, this is something. First of all, thank you for having me and on this topic in particular. This is something that the industry started looking at the fourth quarter of 2020. And actually, you could go back as far as when we changed the settlement cycle from 3 days to 2 in 2017. People were thinking that was just a way station to get to T+1. And so I think the desire is to mitigate as much risk as we can from the system, eliminate the need to hold excess capital at DTCC, but still be able to preserve the various aspects of the securities market, things like securities lending, prime brokerage, that are important facets of the marketplace. Right. The only other thing I do want to add, you pointed out, it's been 100 years to get back to T+1. I was looking at something today. 100 years ago, I think the average daily volume in equities in the U.S. was something like 4 million. Today, it's 11 billion. So a lot has changed in the U.S. capital markets over the last 100 years.
Yeah, and I think 100 years ago, we were driving it around by courier, right? In some capacity, biking it, walking it. So that was also a big difference. Do we know if it went well?
Well, we're really in the process. I mean, the industry spent the weekend, and this is a partnership between SIFMA, the Investment Company Institute, and DTCC, working with the broad industry counterparts, our buy-side, sell-side members, along with the various utilities and service providers. And so it's an all-hands-on-deck effort that we've been working on for almost 4 years. But in the last, several months, an ongoing weekly effort that culminated beginning at the end of last week with setting up an industry command post that's been running through the weekends, running right now. It's also been in coordination with our partners in Canada, Mexico, Argentina, Jamaica, and Peru, all of whom went to T+1 yesterday. And so they will be having their double settlement today. In the U.S., which obviously is a much larger market by a long shot, tomorrow will be the double settlement today. So securities that change or trade today will settle tomorrow versus whereas securities that traded on Friday will also settle tomorrow. So that's when the rubber hits the road. But a tremendous amount of work has been put into this, and we feel very optimistic about where we are.
Certainly so. Are you concerned at all, particularly with the double settlement tomorrow, and then, of course, with the MSCI rebalancing? Is there any concern here about any sort of hiccups?
I think what members are reporting to us, what the various service providers are reporting, DTCC, is that all systems are go. Everyone's ready. We've had the experience of seeing what's happened in these other markets, in particular Canada, which is the largest of the other markets. They seem to be handling it well right now. So again, I think we're optimistic. I think we've taken every precaution that we can. We've tried to inform the broad aspect of the industry. We're looking at the cross-border implications where they're not shifting to one, and I think we're prepared for that.
Well, let's talk about the cross-border thing, because that's a big issue. A lot of foreign investors have basically made it clear that there is still, even once you sort of get everybody on the T1 page, you're still going to have issues with regards to currency transfers and the idea that that's not going to be completely in sync with the time that it takes to settle. What is the solution, if there is one at all, to make sure that that still is seamless?
Well, I think people have pre-positioned for it at this point. And obviously, remember, when the U.S. shifted from 3 to 2, we were behind much of the rest of the world, which had already gone to 2. And we expect that most of the world will follow to 1. The UK has already said that they're going to do it by the end of 2027. We expect the EU to follow suit on that as well. And obviously in the FX world, that sector has been making provisions for this, and I think we'll probably see more activity among service providers there as well.
Ken, I have to ask you too, and I know you guys have been preparing for this for years, and we've talked with so many banks, and they've made it clear they've all got these contingency plans in place. But some of those same banks are also saying they are concerned about the risk, at least in this transition, of failed trades, not just today, but really over the next couple of weeks here. If we do end up in a situation where we see major failed trades here, is that going to have a ripple effect, or is that going to be something that's, I guess, a little bit more contained, isolated to just that particular transaction?
Well, we've had periods of volatility where we've seen a spike in fails, and we saw that in March of 2020 with the onset of COVID and the reaction in the U.S. We saw that during the meme stock incident in 2021. Industry's been able to come together. SIFMA's been very much involved in this of working to allow firms to work to settle out failed transactions. Is there a chance that we'll see a spike in fails with this transition period? Sure. But again, we think that the provisions have been made to address that if that occurs. but that over the long run, we think that the market is ready for the T1, that the work has been done to get us where we need to be.
If we do see some failed trades, do you think it will be because of, say, the FX issue, because you have to convert into dollars? Will it be securities lending? They have to get those shares back, or allocation confirmation process, because some of the trades are just smaller than the bigger ones we used to see. Where do you think the biggest crack will be?
It's a good question. It's hard to say. I think it's probably going to be more one-off situations where perhaps firms are not as ready as they might be, or there could be something that no one thought of. But right now, we're not seeing any of that, and I think I think it probably will be more I hope it'll be more of an anomaly than anything that is systematic.
All right, Ken, I'm going to have to leave it there. Always great to catch up with you. I know you're a busy guy right now. Ken Bentsen, President and CEO over at SIFMA, as those T1 rules take effect today here. Everyone right now, Alex, on guard here for maybe some potential disruptions, but at least based on what Ken said, as well as some of the banks that our Bloomberg reporters have interviewed here, they seem like they're prepared for it.
Yep, and I mean, at least they had a lot of time to prepare for it. But yeah, okay, I mean, bumps in the road.
Years.
Yeah, 100 years apparently. I just can't imagine T+7.
Yeah.
So I was talking to Paul Sweeney on radio earlier. When he was an investment banker, it was T+7.
I believe that here. We've already spoken to a couple people. They said, look, back when they started their careers here, I mean, you waited a week to get your money or get your shares or whatever.
Were you walking to the, like, what did that even look like?
Because it was all paperwork. It was basically somebody, signing off on a paper and you send it down to the basement. They got to notarize it. Then you got some courier that's got to bike it across, like the wilds of Manhattan. It was a lot, Alex.
I know, but
still, think about
it wasn't
the age we live in now.
Buggy time.
It's like sort of.
I guess.
All right. We're going to come back here into the future here and take a look at some of the big movers on the day. Celsius, the drink company that is having one of its worst days in a couple of years here, a downgrade and some concerns about the sales trajectory of what was one of the hottest stocks on the street. It is our stock of the hour, and it's coming up next right here on The Close on Bloomberg. All right, time now for our stock of the hour, and we're taking a closer look at Celsius Holdings. This is the maker of energy drinks. The shares right now running low on fuel after a note from Morgan Stanley flagging a significant slowdown in sales growth this month. Abigail Doolittle joining us right now to talk a little bit more about at least what right now is the worst intraday drop going back to 2021. But the interesting thing, Abigail, about this note, the analysts cited a drop in sales in the most recent week. And when we get a 13% sell-off on that, what am I missing here?
Well, that's exactly when I started to look at the tape when I was told that this is what we were going to talk about, what's going on here. It doesn't make any sense. And on a one-day basis, we were just showing a chart of the stock down 10% over the last 2 days. It's down double digits, to your point, the worst day since 2021. And if you look at the data over the last month, which is the way apparently more people do look at it, we're actually looking at growth of 11.6%. That's up from 11.4% in the previous month and 11.3%. It's also up 3.2% on a year-over-year basis. So again, a big head scratcher. But I think what's going on for this stock over the last 5 years or so, up about 75%. Over the last month into this sell-off, up almost 50%. So price for perfection. I think people wanted a little bit more growth.
Well, that's what I was concerned about, because I mean, when you look at the uptick that you saw in the shares over the last year, and I think the PE is something like 70 or something times earnings. So
also, I wonder. It looks like there probably was a lot of short covering back in March and February.
Agreed.
If I just look at the short interest.
Yeah.
So, and it looks like the short interest is pretty low now. So I have to wonder what that leads to it too.
I think that's a great point. I think that there's definitely a short play here on this stock. It's about 10% short interest. I think what we're really looking at in terms of this long-term uptrend, if you look at it, the stock goes up, and then it comes back down to the 200-day moving average. I think right now we're probably going to go to either the 100-day moving average, which I think is at 63, and then the 200-day moving average, the 100-day moving average at 73, 74, or the 200-day moving average at around 65. What happened about a year ago, Celsius received, and they're these all-natural energy drinks, apparently very pure. They had a contract with PepsiCo, $500 million in preferred stock for distribution deal across the country. So they were no longer just in, like, say, the warehouse companies where you could find it. So a big distribution. So that's one reason why the stock is up so much.
Well, that's right. Yeah, you started popping up everywhere.
Yeah.
You walk into any store in New York, and it's like, and they have their own display and everything else.
Exactly.
So that was probably because of the deal with Pepsi. Have you tried these things?
Absolutely not.
Okay. Have you tried these things?
No, I don't. I'm scared.
Well, we interviewed the CEO, and we had all these different flavors, and so the CEO's like, he's a very charismatic guy, to say the least here. So you kind of see where the marketing hype went into it. But again, at the end of the day, there's so many energy drinks on the market. So if you're into that type of thing, you've got a lot of choices.
Which then, to your point about the numbers, they're not terrible, but considering the partnership with Pepsi, then maybe it does look a lot worse than you would have thought, right?
And the thing that would distinguish them, though, is it is apparently all natural, pure. So as compared to,
have you verified that?
Well, that's what I was told by an analyst.
You don't like energy drinks?
Do you like energy drinks?
Are you against energy?
I'm against
I love energy, but I probably, in coffee, I have had Red Bull once or twice. It tastes like a sweet tart. Not really my thing.
Have you had the Celsius drink?
I have. It's fine. I don't drink that much caffeine, but I've had it. It's fine. It's not something I would put into my daily diet.
Is it worth the stock being up 7,500%?
I see the popularity, and like I said, you go anywhere. You go into a gym, you go into a bodega here in New York, go into a grocery store. It's there. So I get why there's been so much enthusiasm around the stock.
All right, Abigail, appreciate it. Thank you very much. All right, coming up, we're going to count you down to the closing bells. Katrina Dudley is portfolio manager and investment strategist at Franklin Mutual. She'll join us next. This is Bloomberg.
This is the countdown to the close. Romaine Bostick alongside Alex Steele. Just about 10 minutes until we get to those bells, Alex, and kind of a mixed day on Wall Street.
It is. We still have a record, though, in the NASDAQ 100 and the NASDAQ, helped by NVIDIA also hitting a record. But honestly, it's not that terribly exciting.
Barely.
The S&P is still
if you breathe, you're going to knock the NASDAQ over.
Yeah. S&P down by about 0.1%. But I do want to point out, yes, tech is leading the S&P higher, but so is energy. That stock up over 1%. Vistra is the second best performing stock within the S&P. That's a power company. It pairs with NVIDIA quite nicely. I just thought I would mention that it's not just tech.
All right, I'll add one more to your board, and that's the VIX right now trading around 13, a little bit elevated on the day, but quite frankly, over the past few weeks, months, even the past couple of years, it has been subdued, to say the least. Mandy Xu, we had a chance to catch up with her earlier, of course, works over at Cboe, and asked her about why volatility has remained so muted.
In terms of why volatility is low, it's largely on the back of positive macroeconomic fundamentals and the Fed really taking the wind out of the sails of the volatility markets with their last meeting and kind of the patience that they have expressed with, willing to wait for inflation to reach their target.
And that was Mandy Xu, head of derivative strategy over at Cboe, helping us to kick us off to the close just about an hour ago. And here to help take us to those closing bells is Katrina Dudley, portfolio manager and investment strategist at Franklin Mutual Series. Great to see you here.
Great. Thanks for having me.
We were talking a lot with Mandy earlier about volatility and how subdued it has been. But is that a true reflection of what's going on? I mean, I know strictly from an options perspective, yeah, sure, volatility is subdued, but there's a whole other universe of traders out there that still seem to be pulling their hairs out, wondering when they're going to be able to go away for summer vacation.
Look, take a look at what's happened in this market. Number one, we have a Fed that is actually giving us clarity, and they're talking to the markets. They're telegraphing what they're going to do. And when you have people that are telegraphing what their actions are going to be, that takes away some of the uncertainty. So as I look at the next couple of months, you've really got a Fed that's just said, we're waiting for the data on inflation. We're going to have the print at the end of this week. What is going to cause the uncertainty, though, is the November election. And that's one of the areas that could cause somewhat of a spike in volatility.
It's interesting you say that. When we start to talk about the election and how that gets priced into the market, do you think it's going to be active, meaning there will be a lot of activity, or is it going to be more people just moving to the sidelines?
I think what's going to happen is that people either move to the sidelines, which is a little bit of weakness in the market, or they're going to look at the sectors which are going to benefit based on who is ahead in the polls. At the moment, I think it's kind of no one's really sure what's going to happen, so no one's really actively looking to position themselves, number one. Number two, we do know, based on the historical data, that leading into elections, markets tend to underperform, and that underperformance is a reflection of greater uncertainty. And so we are expecting that going into November. And then once we have the resolution of the uncertainty, we would expect the market in its entirety to go up. But we don't know exactly which sectors because it's going to depend on who wins.
And also interesting, if you look at the VIX curve, as we were talking about earlier, it reverts very quickly. Like there's a spike around the election and then it reverts. So it's not like it's a prolonged period of risk.
Yeah, but the good news is that, if you're talking about those summer vacations, people are going to be able to have an opportunity to take some of those summer vacations. The Fed's been very clear in telegraphing that, it will be a couple of months before, they really see inflation is under control. And, when I look at inflation, I always talk about it. We've been talking about weight loss drugs, but even with weight loss, when you get the first pounds off, they're the easiest ones to get off. It's those last bits as you get closer and closer to your target that are tougher. So I do think it will be much slower for us to reach our target inflation levels.
The one person that likes the Fed speak. It was like 19 people last week. She's all into it. I did want to point out that just talking about the sectors that are doing well, like it's not just tech, right? I mentioned utilities and power companies, et cetera. Where are the bets that are in a structural trend that can be a little bit more immune to, say, rate cuts, hikes, whatever?
So if you take a look at NVIDIA and you look at their earnings that just came through, you had a very strong print. But AI doesn't just benefit the chip makers. You need power. And the amount of power that you need to power some of these new chips is significant. So we actually think, even for a value investor, a value sector such as utilities actually has an opportunity to benefit from this high growth sector because the use of AI and the increased deployment is going to be a much greater draw.
You think that's going to be sort of a long-term structural trade, or is that more tactical?
I think this is a long-term structural trend that just supports these companies. And if you think about it, when you're a utility and you've got forward visibility, what do? Is you invest capital today. So you put that capital in and then you earn the regulated return. So we just think that the structural case is actually about getting forward visibility.
The structural case there, and obviously that has been a big theme in the markets and will continue to be. Just a couple minutes ago, you used the analogy of weight loss. So another big theme I'm going to ask you about is weight loss drugs, because we talk about that as an investable opportunity beyond just investing in Lilly or whoever else here. Do you see that as something that's also structural and long-term in nature?
I think when we look at some of these weight loss drugs, we need to have the reimbursement available for a much greater portion of the population. And I think that, for the investment case to continue to work, I think there's been a lot of focus on those companies which are not benefiting or that, are losing out, say the sugary drink companies and the candy companies. I think as we kind of get to a settled stage, I think that you'll have people who use the drugs and then hopefully come off them. And I know that that's a big area of debate, but I think that that's what I see as a good sustainable future. And therefore, we're going to take a look, not quite ready to step in, but some of these companies that have been disproportionately punished are some of the times where the market just gets overly negative about how damaging these things can be. And that actually creates the investment opportunity.
Before I let you go, do you like bonds? Do you like the 2-year? Just sit, wait, happy, right around 5%?
I think if you've got cash sitting on the sidelines getting 5%, come on. 2 years ago, we were talking about zero. So I think that there's a good opportunity there. I think the markets we've talked about this, they're relatively fully valued. So I think that you're just sitting there and having a little bit more of a balanced portfolio makes sense.
Would you recommend people lock in on a longer term rate at this point, or you don't think that's appropriate?
I think that the market is pricing in probably 2 rate cuts going into the end of the year. I think we're probably more in the camp of about 1. So I think that you've got a little more there to come before you want to start doing things.
All right, Katrina, always great to talk to you. Great insights as always. Katrina Dudley over at Franklin Mutual Series, helping us count us down to those closing bells. And Alex, seeing a small bid come into the market as we get closer to the bells, at least for tech stocks. So you see the NASDAQ, you see both the 100 and the composite, and the Philadelphia Semiconductor Index, and those are your bright spots.
Yeah, and Stuart Kaiser over at Citi was like, are we just going to basically chase the rally again, just continue it, or you want to take a little profits? Like, those are your 2 choices until we get an actual catalyst.
And
chase or profit?
Yeah, and what's that catalyst going to be? The Fed, earnings, Black Swan?
I'm assuming it's going to be Jobs Day, June 7th, but I genuinely am skeptical on that too, because if the data is still steady as she goes, what is going to be that moment?
Yeah, good point here. All right, we are moving closer to the closing bells here on this Tuesday afternoon. A full breakdown of all the market coverage right here on Bloomberg as we take you to the bell and beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic alongside Alex Steele. We're counting you down to the closing bell. And here to help take us beyond the bell, it's a global simulcast. We're joined now by Carol Massar and Tim Stenovic as we welcome our audiences across all of our Bloomberg platforms, television, radio, and our partnership with YouTube here on a somewhat tepid trading day. Carol Massar on this Tuesday afternoon.
All I'm thinking, is it Friday yet? Yeah, exactly. We have definitely seen.
What's happening?
I don't know. It's just that kind of a day.
Carol said it was Monday on air earlier.
And thank God,
right at the top of our show. Happy Monday.
Yeah, move up in yields, waiting for some more economic data. It's going to be interesting. Some more Fed speak before they stop talking ahead of the upcoming Fed meeting.
Countdown to the blackout period.
That's me.
Continues to be on.
Yep, week 2.
Just to point out, hold on a second. Katrina Dudley doesn't seem to mind the talk. We just had her on, and it's like, she likes the fact that they're being clear. She likes the fact that they're talking, and that's why the volatility is relatively subdued.
I love the talk. It gives us something to talk about when they talk. What do we talk about, Romaine, when there's a blackout period?
How many times can we say talk?
Well, I mean, what would we talk about when there's a blackout period? We talk about the Fed being in a blackout period, which I think is exactly what Carol will be doing here. But I was just going through it. Look, it's like you got Messer already out there, Bowman, Kashkari, we heard from earlier today. You got Cook speaking, I think, also. And that's just today. And I don't know what any of these people are saying other than what they said maybe yesterday, last week, or the week before.
I think that's the point. And that's it. It's not actually moving markets at the end of the day, but at least they're all clear. They haven't changed their point of view.
Yeah. All right. Well, I mean, maybe the fact they're not talking has been somewhat good for the market. An S&P 500 that spent a good portion of the day in the red, actually flipping into the green as we get the closing bells. These numbers take a while to settle, so take it with a grain of salt. But the S&P is only up by about 1 to 2 points on the day. That's in the green, but once again, takes a little while for it to settle. The NASDAQ will decidedly end in the green here on the day, with the NASDAQ composite up about 99 points, or about 0.6%, and the NASDAQ 100 up about 61 points, or 0.3%. The Dow, meanwhile, decidedly in the red, down 200 points, or 0.5%, while the Russell 2000 is going to close out the day lower by about 0.1%.
Yeah, most names in the S&P 500 actually lower in today's session, 367 to the downside. What it was good, Alex, is to be a semiconductor name, because the stocks was up about almost 1.9%. A lot of that had to do with NVIDIA, which I'll talk about in just a moment.
Yep, and just take a look at the IMAP function here on the Bloomberg terminal, and it really shows the breakdown. You obviously have information technology outperforming up 1.4%, but I was pointing out earlier, it's not just that, it's also energy outperforming as well, up by a full 1 percentage point, followed by communication services. Exxon, the best performer within the energy sector. And on the downside, the cyclical stuff. You got financials, healthcare, and industrials all down by over 1%, Carol.
All right, that's your big sector play, if you will, on this Tuesday. Let's get to the semiconductor space. NVIDIA finishing just off its highs of the session, still a gain of more than 7%. It's the number one gainer in the S&P 500 and the NASDAQ 100, up 6 days in a row. Last check, it was up more than 20% in those 6 days. So talk about a move to the upside to another record high. Today, the street just continuing to pour their love for NVIDIA. B of A's triple momentum screeners find stocks, including NVIDIA. Melius research analysts saying NVIDIA's margin stands out and is, quote, worth paying for, highlighting a metric that he says shows why the chip giant is truly unique, and that is the company's 69% margin on the basis of earnings before interest and taxes, performance that the analyst calls nothing short of extraordinary. Meantime, NVIDIA stock will surge 258% from current levels and hit a $10 trillion market valuation by 2030. That's according to IO fund tech analyst Beth Kindig. And perhaps the stock maybe even got a boost from Elon Musk's AI startup XAI, which raised $6 billion in a bid to challenge OpenAI. So there's just so much going on and so much love around NVIDIA. GameStop, talk about love. Up 40% at its highs, finishing the day with a 25% gain, rallying again. The company said it brought in nearly $1 billion from a share sale program amid renewed interest for the so-called meme stock. The video game retailer on Friday said it capitalized on a flurry of trading earlier this month by selling 45 million shares to raise just under that $1 billion mark. AMC was also higher today. So GameStop up 25%. I'm coming.
Well, no, the memes are up again.
I know.
Like 25% for
I kind of was like from the sublime to the silly, from NVIDIA to GameStop. Insmed.
I'm sorry, what just happened there?
I'm just saying it's a little crazy. Insmed, ticker INSM, up almost 120% in today's session. This after the drug developer said a late-stage study of its experimental therapy for lung disease met its primary goal as well as several secondary endpoints. It's about a $6.8 billion market cap, and the company's stock now up about 50%, but again, up almost 120% in today's session. All yours, buddy.
Okay, thank you. You got the gainers, I got the decliners. I do want to start with Moderna, among the worst performers on a percentage basis in the S&P 500, falling more than 8%. Ahead of this, though, it was up a record 10 days in a row. It reached the highest level since February of 2023. Can't go up every single day. It paired some of the earlier losses. It was down as much as 11%, but at one point it was the biggest drop since February of 2022. It's up so far this year, more than 54%. And then shares of DraftKings falling more than 10% today, falling the most intraday going back to November of 2022 after a progressive tax on online sports betting passed in the Illinois Senate on Saturday. Analysts said the potential for other states to follow suit is the primary concern for investors. So if it's approved in the House, the new tax would take effect starting on July 1st, and operators are going to be liable for increasing tax rates based on their adjusted gross revenue. So they could end up paying between 20 and 40% based on revenue thresholds compared with the current 15% right now. So certainly will affect those companies' bottom lines. But the one I really want to talk about is Celsius Holdings. Shares dropping the most since May of 2022 after industry sales data signaled that the company's revenue growth is cooling. Shares falling by close to 13% today. It did tumble as much as 19% intraday a little earlier in the session. Morgan Stanley's Eric Sirota cited Nielsen IQ data that said that Celsius's year-over-year sales growth slowed during the week ended May 18th compared to earlier in the month, so sales slowing concerning investors. Up 50% so far this year. It was up 57% last year, 39% in 2022, 48% in 2021, and 940% in 2020. So in the last 5 years, it's up 5,800% just in 5 years.
Okay, well, that's a move.
It's a move. A little bit of a pullback today, though, I would say.
All right, so we'll just discount that 13%. I'm taking a look at the bond market here, guys. So we had a 2-year and a 5-year auction today. Maybe unusual we get both in one day, but they weren't that great. The bid to cover wasn't that good. Yields kind of pushed higher across the curve, particularly in the back end. And tomorrow we get the 7-year, about $44 billion worth, so that will be quite interesting. I mean, we're taking down the supply, but yields got to go higher for that.
Yeah, interesting you bring that up, too, because you talk about how that folds over into the mortgage market. And I know, Carol and Tim, you guys have been keeping an eye on what was an interesting story here about mortgage rates actually climbing back up. Am I reading that right?
Yeah, exactly. And what's interesting is with these mortgage rates stuck around 7%, you've got a younger generation for the most part, and just individuals kind of rethinking whether or not buying a home makes sense anymore. And that whole idea of, right, you went to school, you got a job, you maybe got married or found a partner, and then you bought a home. It's the American dream for generations. And maybe it just doesn't, Tim, financially make sense anymore.
I think it, and I kind of had this realization while I was reading this story and looking at some of the examples of the folks that Paulina spoke to, Alex, but the fact that you can rent in Westchester for $3,500 a month, which is, a fraction of what this guy would be paying if he took a mortgage on, had homeowner's insurance, had all the other homeownership costs associated. And now he's using the down payment to invest in, a 5% savings account. So he's like making a guaranteed 5%, at least for now, on that. It made me think, you know what? Wait a second, maybe owning a home isn't the best financial decision right now like it used to be. If you can invest that down payment and pay a lot less than you'd be paying on your mortgage, then it absolutely makes sense to rent right now.
Yeah, that's actually a really good point. And it's a different way of accumulating wealth because that's how you think about home owning, right? You buy it, then you sell it, you upgrade, and then that's how you sort of build your wealth and then get bigger and bigger. But if you're right, if you can sit in a 5-year for 5%, maybe that actually is a bit better if you do have to rent. But, it is interesting with the new home sale market. You've had a lot of builders continuing, though, to offer concessions in the hopes that you will draw in those new buyers because we still need those buyers and there still is a lack of supply.
So I shouldn't invest in the home, but maybe in CDs. Alex, what about investing in movie theater companies? Is that a better proposition?
Not if the data over the weekend had anything to say about it. Did you guys see this? That you took a look at what
no one
Furiosa,
saw it,
apparently Furiosa, the next in the Mad Max saga, the latest installment, only took in $32 million. Garfield the movie almost hit that and beat that.
I would watch that.
I hadn't even heard of either of these movies.
I was actually.
What? You haven't heard the Mad Max saga? Where are you?
I've heard the first Mad Max. I saw the first Mad Max.
That wasn't the first one. That was the latest one in a long saga over decades.
The one a few years ago.
Maybe the saga
has to end. The one in the desert. The one in the
desert
where they drive fast.
Yes.
That's the one I saw.
think that's all of them.
A few years ago.
It is all of them, actually. Yeah.
You know, Mel Gibson.
How much
before your time?
Yeah, I'm sure it costs a lot of money I don't. Maybe we wanted to be outside. Maybe we're just tired, or maybe not every movie's good. Right?
No, but that's the point.
But it wasn't even just this movie. I mean, there were a couple others that also came out that also underperformed. So I don't know if it was just the quality of the film.
It's supposed to be good.
Well, I guess somebody will tell us eventually.
There's a lot of good stuff on streaming, and I'm paying like millions of dollars for all my streaming channels. So maybe I'm just going to watch that.
Oh yeah.
Maybe that's a good point. Maybe that's actually part of it.
Can you do mind sharing your password? I'm trying to save some money here.
Nope.
Trying to buy a home in Westchester. What's going on?
Exactly. All right, guys, that's a wrap. How many more days till Friday? 3 more days.
3.
Not that I'm counting.
Oh.
All right, that's a wrap.
Math.
Across platform, radio, TV, YouTube, Bloomberg Originals, folks. We will see you same time, same place tomorrow.
All right, stick with us. A lot more coverage coming up here on Bloomberg Television. Dana Telsey going to be joining us as we dig through the racks on the retail sector. A big week up ahead for earnings out of those names. Stick with us. This is The Close on Bloomberg. Welcome back to The Close. Romaine Bostic here with a closer look at how the markets performed on the day. Green for a couple of the major indices, including the S&P and NASDAQ, though the gains were fractional to be sure, and volume lighter than normal. One of the big bright spots on the day has been the big bright spot on the year, and that are chip stocks. The Philadelphia Semiconductor Index closing out the day higher by about 2% to a fresh record high there. Yields, as you can see, moving just slightly on the day, and a little bit of a pullback that we're seeing in the crypto space. Some of the individual movers on the day once again are in the chip sector, with Nvidia leading the S&P in terms of percentage gainers, while Moderna leading the percentage decliners on the day with an 8% drop here. Moderna continuing to slide. Meanwhile, Insmed, a small company that actually saw the latest results out of a study involving its drug for a rare lung disease, showing some encouraging signs. Those shares doubling on the day, and DraftKings pulling back, actually having one of its worst days going back to August of last year. Some concerns about a new tax in the state of Illinois. But our big story today is a big focus on earnings from retailers. Coming off some mixed reports from last week out of Target, Macy's, and TJX, this week brings us dozens more. That includes Abercrombie & Fitch, Capri, Kohl's, Nordstrom, Gap, and Ulta Beauty. The earnings arriving amid fresh data showing that the confidence U.S. consumers have in this economy has actually improved. The Conference Board's gauge of sentiment released this morning, increasing to 102 for the month. That beat all economists' estimates. Consumers' perception of current economic conditions, that climbed for the first time since January. And their view of future conditions, that jumped by the most since July. Now, there still is some economic anxiety out there, with more consumers saying recession is either somewhat or very likely in the next year. But for now, right now, their views on the labor market and business conditions offer a bright spot for department stores, apparel makers, and other sellers of discretionary items looking to keep those cash registers ringing. Joining us now to offer her insights is Dana Telsey, the founder and CEO of Telsey Advisory Group, to take a closer look at the retail space. And Dana, let's start with apparel makers here, because this seems like a little bit more of a mixed bag. I keep hearing that apparel makers are doing okay, but then they're saying that it kind of depends on exactly what you're selling.
You're exactly right. And first of all, thank you very much for having me. Mm-hmm. It is a mixed bag overall, and I term this consumer as squishy because there's ups and downs. We've certainly seen denim jeans do well, given the Western look that's out there, favored Levi's. We're going to get Abercrombie tomorrow morning, American Eagle after the close. Around 35 to 40% of sales comes from denim. We've been on a tear with Abercrombie, and we think we're going to continue to see some very solid results with improvement in Hollister. Let's take a look at American Eagle also, because their Aerie business, Intimates, has been solid, and they've put in a new game plan updated for the American Eagle Outfitters brand that's expected to take hold as we go through the year. That's going to be something to watch for tomorrow when we hit earnings.
We're also expected to get Gap later this week. And at least traditionally, when I think of denim, I mean, I'm people of a certain age, you think of Gap. Is that still appropriate?
I think overall Gap reports after the close on Thursday, a little bit different. When you think of the business of Gap, it used to be a lot of Levi's. Now it's its own brand. You have a new CEO in place who's working to reinvent, modernize, and make the Gap brand younger. With collaborations that have gone on, the hiring of Zach Posen as a creative director, they're looking to re-energize the brand. It feels like it's happening a bit in the Gap brand. Still work to do on Banana Republic and also on Athleta. Old Navy should have appeal to those consumers who are watching their wallet.
I am curious about the department stores. We're going to get Nordstrom. We've already got Macy's, so we've kind of got a little peek as to the health of the department store model. And I know each of these companies, they kind of have their own idiosyncratic issues here. But when you look at the department store model, is that something investors should still be embracing?
It's been challenging for department stores. When you have the strength of own brands opening their own stores, having their own websites, off-price gaining share, there's been a lot of market share shifts away from department stores into other venues. They need to get younger. Nordstrom's lucky that they have Nordstrom Rack. That's where the growth is. Macy's, with their new CEO, putting in place the bold new chapter strategy that still has to prove itself out over time.
One of the interesting things, and I had a chance to catch up with the CEO of Macy's last week, and one of the things they really touted was the strength of beauty products. Specifically, he focused a lot on cosmetics as well as the perfumes and stuff. Is that a broader trend?
We've seen beauty be very strong, and it is the category when you hear from Dillard's or a Macy's that it's the category of strength. Yet Ulta's, who's going to report this week after the close on Thursday, they've seen some category moderation. You're not going to have the double-digit increases in the beauty segment as you did over the past 2 years, but it's still a very good category with fragrance and certainly skincare being strong. New innovation on the way in makeup in order to drive demand is the focus.
Do you think in the beauty space, is that, maybe I won't use the word recession-proof, but is it recession-resilient? Because some of these CEOs seem to be touting the idea that no matter what, we're still going to want to splurge on perfume and things like that.
I think you are still seeing strength in beauty. We heard Sephora's results and they were solid. But the new element in beauty, people's daughters are also spending a lot of money on skincare also. They're getting started at an earlier age. And the Gen Z and younger audience, they're focused on beauty. Even at Bath & Body Works, with men's, lip, hair, and laundry, it's been an area that's grown in sales.
All right, that's interesting. I'll have to take a look at that. Luxury, we got to talk about that. We do get Capri, so I guess that's sort of representative of at least a U.S. homegrown luxury brand here. That should be recession-proof, should it not?
No, luxury is not recession-proof, and it all depends upon who you're catering to. The aspirational customer that a Tapestry or a Michael Kors, which is Capri, caters to, you have to come out with new and innovative product all the time to drive demand. For Capri overall, which is in the midst of a Tapestry Capri potential combination, it's going harder than expected and taking longer. So I think you've had stronger results at Coach than what you've seen at Michael Kors, and I expect that to continue.
Do you think, though, when we talk about the luxury brands overall, not just Capri here, is the resiliency going to be found in a U.S. consumer? I know a lot of these brands are very dependent on foreign customers, at least foreign to the U.S. Is that the growth overseas?
The highest income level consumers can always continue to spend. And that's why whether it's Hermes, Brunello Cucinelli, or some of the highest end brands, they typically are impacted less. Everyone would benefit from a traveling consumer from China, and we've still yet to see that. So luxury goods sales, which are up over 50% since 2019, are not showing the same rate of increase on a year-over-year basis in 2024.
All right, Dana, always great to talk to you. Dana Telsey over at the Telsey Advisory Group. A closer look here at some of the big earnings out of retailers this week. And be sure to tune in tomorrow right here on The Close. We do have a conversation with the CEO of Abercrombie & Fitch, Fran Horowitz. All right, with a huge slate of retailer earnings out this week, let's take a look back on this day in history. In 1951, and one of the biggest retail price wars ever launched, Macy's and Gimbels, the two New York department store titans of the time, had been in intense competition for decades, even hosting rival Thanksgiving Day parades. Gimbels in Philadelphia, Macy's over in New York. The stores often would undercut the other on price, such as in 1930, when Gimbels began selling a toy ray gun at a below market cost of 19 cents. Macy's was selling the same toy for about 50 cents. Now, that rivalry, it intensified over the next decade and was even a major plot point in the 1947 classic film Miracle on 34th Street. But the laws of the time actually limited which items could be discounted and by how much. The main law here in the U.S. linked back to the Great Depression, when the U.S. fixed prices on numerous essential items to stabilize businesses. Subsequent laws and regulations expanded on that idea, giving U.S. states the power to set minimum prices. The most restrictive were so-called fair trade laws adopted by 45 states, where if one store agreed to abide by a manufacturer's minimum selling price, the government then required all merchants to abide by that minimum as well. Now, that artifice came crumbling down on May 21st, 1951, when the U.S. Supreme Court ruled in favor of easing those fair trade regulations. A week later, on May 28th, Macy's cut its prices 6% across the board on almost 6,000 fair trade items. When Gimbel's matched the 6% cut, Macy's would then slash prices another 6%, and so on and so on. Men's suits that had been selling for $32 dropped down to $19 in a matter of days. Fountain pens were discounted to $2 from $4, and kitchen pans went to 45 cents from around $1.40. Imagine that, 40, 50, 60% price drops on thousands of items all at once outside of the holiday season. It created a frenzy. The stores erected inventory charts in the lobbies and windows and would cross out and scroll new prices almost every hour. Customers would crowd around until they saw a price drop big enough to lure them over to the sales counter. Each store deployed teams of undercover shoppers to go to rival locations and check prices and then return to the home base to mark down whatever they felt would undercut their competitor. The price competition dragged in other New York retailers as well, including Bloomingdale's, Saks, and Abraham and Straus. Of course, something this sensational couldn't go unnoticed by regulators in Washington. By July of that year, the Federal Trade Commission had fielded numerous complaints of deceptive price practices and began to refine the rules that were in place. Ultimately, though, the price wars ended for more practical reasons. Heavy discounting obviously boosts sales, but often at the expense of profit margins. As the year wore on, Macy's executives made a decision to choose profitability and peace rather than continuing to fight that price war. And while discounting didn't end, it did revert back to more normal and seasonal discounts rather than that frenetic, anything-goes chaos stirred up in late spring of 1951. All right, that was a look back in history. We do want to bring you back to the here and now as we are getting some earnings out there, including from the fast casual chain Cava, beating sales and profit estimates and lifting its annual sales outlook. But as you can see, investors apparently not all that pleased. We're going to take a deeper dive into what's moving the stock when we come back right here on The Close on Bloomberg. All right, let's get more insight on those results out of Cava. EPS coming in at 12 cents a share, revenue up 28% in the quarter, comp sales also being guided higher for the full year. Daniela Sirtori joining us right now, Bloomberg News restaurant industry reporter. Despite some of these good numbers, at least what looks good to me, Daniela, we're seeing the shares move a little bit lower here in after hours trading. Talk to us about the expectations coming into this earnings season, because when I see a guidance for 4.5 to 6.5 comp sales growth for a fast casual restaurant, why is that not good?
That's an excellent question. I mean, particularly in the context of what we're seeing in restaurants, a lot of other segments, including like fast food and even the likes of Starbucks are struggling. But Cava was already up 93% this year. And when we compare it perhaps to results of some of its peers like Chipotle actually grew traffic. Sweetgreen held traffic flat. Meanwhile, Cava said that their traffic pulled back a little bit. They said it was mostly because of weather, which other restaurants have also pointed to. But, that perhaps isn't, sitting too well with investors.
When you look at the strategy, and we've talked a lot about Cava since they went public, kind of their strategy of locating retail locations and their whole growth strategy here, do you think that any of that might have contributed to some of the reaction that we're seeing?
Well, interestingly, Cava is one of those, restaurants that is mostly located in, suburban areas. This has been the long-term strategy. And, in the results that came out today, they even said that they were going to build a couple more restaurants than they expected at the beginning of the year. What we're seeing in general is that people are still, yes, they are returning to work, but they're still sticking to working from home in many occasions. And that's benefiting restaurants that have, good footprints in the suburbs. And, in fact, Sweetgreen is sort of, following on that strategy.
What's sort of next for this company, Daniela, when you're sort of covering this company and you're thinking about what we're going to end up talking about 1, 2, 3 quarters from now, what's that going to be?
So, we're keeping a very close eye, in general, but also for fast casual chains when it comes to traffic. They've done pretty well so far, especially, compared to their fast food peers. The likes like McDonald's have actually said that they're losing customers, particularly on the low end. But overall, with fast casual, people are still going, even though it is technically more expensive than fast food. But the price gap has gotten a lot smaller, so some people just prefer to pay a couple extra bucks there. And so it's going to be traffic. And Cava says that their new, stake is probably going to help, at least with their same-store sales.
All right, Daniela Sirtori there. A closer look at Cava shares down 7% here in after-hours trading. When we come back after the break, a conversation with Matt Brown, founder and CEO of CAIS. Welcome back to The Close. We turn our attention right now to the growth of alternative investments. Take private credit as one example. According to Preqin, assets under management have grown to $1.7 trillion as of last year. And that's created a lot of opportunities for those folks really looking to pair up and matchmake with investors. Matt Brown joining us right now. He's the founder and CEO of CAIS. The company runs a platform that connects independent financial advisors with alternative asset managers. Matt, great to have you here. We should point out this was a company started quite a few years ago before I think all attention really turned to this space. I mean, you're looking pretty prescient and smart right now. What kind of gave you sort of the impetus to think that you could go down this road and that it would be successful back in, what was it, 2009 or whenever you started this company?
Well, thanks, Maria. Yeah. Thanks for having us. Thanks for having me. It's been quite a journey. Yeah. In 2009, with the global financial crisis, we kind of took a pause, my partners and I, and said, okay, what is one of the biggest needs that we see? And many of the public market securities, of course, were having a very challenging time. And we looked at the wealth management channel and their lack of access to alternative investment strategies. And that really kind of kicked off this journey that we've been on. But it really hasn't been until the last 5 years where I think a lot of the markets caught up to the value. I'd kind of always look at it that for so long we were asking, the advisors to adopt our platform, and they were asking why alternative investments. But that time is over. Now they're really saying how alternatives. And the CAIS platform is really stepping in to solve that problem. Well, let's talk about the types of alternatives. I mean, we mentioned obviously the two big umbrella baskets, if you will, private credit and private equity. Yeah. I mean, what's the general breakdown, at least through your platform, as to which ones they're investing in? Well, the platform offers all alternative investments, but the growth that we've seen in the last 12 months in different strategies is actually quite remarkable. Private credit is leading the pack. It's up over 45% in the last 12 months in terms of volumes on our platform, meaning financial advisors actually wanting to allocate to that strategy. However, if you compare that with just private equity, it's still only 20 to 30% of the size of the private equity market. So I know a lot of people talk about the size of or the growth of the private credit market, but really compared to the private equity market, it still has quite a long way to go. Are the volumes on the private equity side on your platform, has that gone down? No, number two. Yeah, they're still rising quite rapidly. When you think about the market that we serve, it's financial advisors that largely have never had access to alternative investments. They've been living with the 60-40 portfolio. And now with platforms like CAIS bringing access, education, and workflow tools to make it easier to understand the strategies and implement them in client portfolios, the modern portfolio has arrived. So now the typical portfolio hopefully is going to be somewhere closer to 50, 30, 20, 20 being the alternative investments. Outside of private equity, outside of private capital, we used to talk a lot about those alts. We don't talk about them as much anymore. I know they don't quite sort of grab the headlines, but people are still investing in those as well. In which ones? Outside of just straight private equity and private credit. Private real estate, for example, is still a popular asset class. Of course, a bit more challenged in this interest rate environment. So we're seeing flows down in that area. But
we're also flows more direct investments into real estate projects.
We are seeing that, but our platform doesn't offer direct investment opportunities, just into the funds of professional asset managers. So, for example, Apollo or a Blackstone, Ares, Carlyle, those types of firms. But we are also seeing, interestingly, a bit of a bump in the hedge fund world. With higher interest rate environments, of course, their short book is producing a little more income. And multi-strategy hedge funds are really kind of navigating these somewhat turbulent times with an election coming up, with obviously a few crises brewing in Europe and the Middle East. So it tends to be, a lot of areas in the platform are getting the attention of advisors. But the big theme is that the alts allocation rate, which historically has been only single digits, frankly, is growing now towards double digits. Remember, institutional investors, they're up at 50%, 40% in alts. And so now the wealth management channel is really gaining steam.
Do you think we're going to see that on the individual investor side, where we get, not necessarily into 50%, but we're going to see it like in the higher double digits?
I think our first stopping point is 10%, maybe 10 to 15% on the average client portfolio. Again, illiquid assets need to be properly allocated in any client portfolio. But for the right client, for the right objectives, alts are making a huge impact on portfolio performance. The private equity world and the alternative industry overall over the past few years has institutionalized so much, and their ability to be able to create and manufacture products specifically for wealth, build educational programs so advisors can get smarter on how to allocate alts, and also have teams to be able to go educate and work with advisors. It's been a big trend.
Talk to me about, though, like sort of what increases the activity on the platform in terms of, we talk so much about sort of what moves the market, whether it's, some geopolitical issue or Jay Powell says something that rattles people. Do those sort of day-to-day events, do they have an impact, or most of the people you're dealing with, they're completely inured to that? They just kind of focus on their long-term strategy and their client goals?
Well, public market volatility, of course, has some impact, but we're in a bit of a moment in time here where you have a multi-trillion-dollar network of assets that has zero penetration largely to the alternative investment community. So really what we're seeing is just steady growth in adoption, month over month, quarter over quarter. I think if we were fully allocated, there'd probably be more conversations around public versus private, but we're just nowhere close to that.
I have to ask you, there's been so much talk and jokes about all the cash on the sideline, so to speak, here. And we know there are a lot of people sitting in cash or cash instruments, and there's a lot of questions as to where that money would go when those people are comfortable enough to invest it in something with a little bit more of a risk profile. Does that go into the public markets? Does that go into the private markets? Where do you think that's going to go?
Look, I think what's happening is that, and I mentioned it just a second ago, the new modern portfolio is no longer just 60-40. A true portfolio allocation now is fixed income, equities, and alternative investments. And that's what we're seeing the top advisors, financial advisors in the U.S. really leading with, and it really is benefiting their end clients.
All right, Matt, great conversation. Really appreciate you stopping by.
Great to be here, Romain. Thank you.
Absolutely. Matt Brown, founder and CEO of CAIS. All right, we do want to get back to one of our top stories on the day, and that is the U.S. stock market going back to one-day settlements for the first time in a century. Of course, a lot has changed over the last 100 years, and so there is the potential for some hiccups, some potential for a spike in volatility, some potential for some failed trades. Larry Tabb joining us right now, head of market structure research over at Bloomberg Intelligence. And Larry, I'm curious as to just sort of what you make of this. I mean, we knew this was coming. We had a chance to catch up with Ken Bentsen earlier, who really talked about how prepared they are. We've talked with a lot of bank CEOs who said they're all prepared for this. Any chance that we could see any sort of material hiccups here over the next few days or weeks?
We could see some hiccups, but I'm not sure it'll be very transparent. The issue will be, a lot of the problems will be that funds will borrow a little bit more, that there may be a greater amount of failed trades, but it would be very odd to me to see like a massive blow up and the Fed having to step in to provide massive amounts of liquidity. It'll be edge cases, and a lot of the challenges will fall to firms' operational staffs.
There's been a lot of talk here about the benefits of this, the idea that the buyers and sellers, of course, get either their money or their shares a lot quicker. Brokers, in theory, are going to have lower margin requirements, assuming that the default risk goes down. Are there any other sort of potential benefits that I'm missing here?
Those are the major ones, that folks will wind up getting their money quicker, that they'll get their securities quicker, that the process will be slimmed down, there'll be less margin. Hopefully less room for error. That said, there's a lot of actual manual stuff that still goes on, and even processing. So if you think of a large asset manager doing a block trade of 1 million shares, the average trade size is maybe around 150 shares per trade. So that 1 million share order gets broken up into 150 share increments, and then it has to be aggregated and average cost, because if you execute them all sequentially for the fund, the people who get in sooner will get a lower price conceivably if they're buying, and the guys last will get the worst price. So everything is average price. So there's just a lot of mechanics. There's also issues around securities lending, just getting back lent securities quicker. Now for the Amazons and the Apples and the Microsofts, that's probably not going to be a problem, but there's a lot of hard to borrow securities out there, mostly small or mid-cap things, stocks. They may be harder for the custodians and the primes to get their hands on, so they may fail a bit more. And I think you talked about foreign exchange, so everybody trading overseas will still generally take 2 days to send money, but their securities trades settle in 1 day. So they're going to either have to borrow pre-move cash, which is an opportunity cost, or have, challenges around that.
So, the net effect of this, once we get past sort of this initial period of adoption and adaptation, Larry, is this healthy for the markets to go from 2 days to 1 day? Is there going to be sort of a material benefit to the health of the market by doing this?
Well, I think once everybody gets their operational, house in order, I think generally it'll be a positive. I think you're going to see that people are basically going to get their funds quicker, and they'll have their securities faster. It'll stress brokers and custodians and prime brokers and funds out a little bit in the meantime while they get their act together. But within a year or so, I expect all these issues to go away. In fact, probably a couple of months. We don't anticipate these issues lasting tremendously long. That said, it could take a couple of months for all of a sudden people to realize, hey, I'm borrowing, X% more. My brokerage costs are going up. I need to figure out why that's happening, and then fix their systems.
All right, Larry, great stuff. Head of market research, market structure research, I should say, over at Bloomberg Intelligence. We should point out here, it was a relatively low volume day, and at least right now, no real ructions from that move to T1 today. The S&P fractionally higher on the day, and by fractionally, I do mean fractionally. The big winners on the day were the NASDAQ and NASDAQ Composite and NASDAQ 100, as well as the Philadelphia Semiconductor Index, a big gain by NVIDIA, pushing the stocks up by about 2% on the day. We did see a pretty material sell-off in the Treasury space, which did push yields higher, up about 3 basis points on your 2-year yield, and a bit of a pullback in the crypto space. We'll be back in a moment. This is The Close on Bloomberg. All right, welcome back. Prosecutors are currently delivering their closing arguments in Donald Trump's hush money trial here in New York City. The jurors could be handed the case sometime this week and could reach a verdict in a matter of days after. For more, we're joined right now by Joe Mathieu, the co-host of Bloomberg's Balance of Power. Joe, this case has been going on for a while. I guess it's anyone's guess as to how it could end here, but we are near the end.
Yeah, this is it. This is the final stage of the trial, to your point, before it goes to the jury, Romaine. And a lot of legal experts we've been talking to think the jury might make quick work of this. 6 weeks and 22 witnesses later. That could happen as soon as tomorrow. You're right. The prosecution, Joshua Steinglass, speaking for the prosecution right now in closing arguments and trying to essentially rebuild the framework of this payment structure that they've talked about for Stormy Daniels. He's connecting the dots with David Pecker's testimony, with Michael Cohen's testimony, because the jury has been out of the courtroom now for a number of days here. This could bleed into tomorrow. As they say, the jury could have this case by the end of Wednesday. Romaine, we could be talking about a verdict this week.
That would be interesting. I am curious as to what the former president is doing, or has been doing, and more importantly, now that this case is wrapping up, no matter what the verdict ends up being, does he get back out on the campaign trail?
It's a great question. He certainly has been talking a lot about it in the lobby of the courthouse, remembering that, Donald Trump wasn't doing a heck of a lot of rallies to begin with. There wasn't that much travel in the early stages of his campaign. So we'll have to see as Joe Biden tries to take advantage of the time that Donald Trump has been there. He's been doing more traveling, even went to Florida at one point. He's going to be back on his way to Pennsylvania this week. But I tend to think that no matter the verdict, you're going to see a news conference from Donald Trump, if not a rally. He has a history of holding big rallies with supporters at Bedminster or at Mar-a-Lago to congratulate him on a big day, in many cases the worst day in his legal career. We'll see how this week goes for him.
All right, Joe, I want to make a hard pivot away from the Trump trial to talk about the situation in Israel, specifically the situation in Gaza. The latest Bloomberg reporting still saying here that Israeli troops continue to move deeper into that city of Rafah. And we did get some commentary out of U.S. officials here about how they feel right now about this advance. What do we know?
Yeah, this would be the Achilles heel facing Joe Biden right now if we're looking at this from a political standpoint here. But you're right, that strike by Israel over the weekend that killed some 45 civilians is a great problem, politically speaking, for Joe Biden. But all we have heard from the administration today through John Kirby at the White House, from the State Department, is that the administration is behind Israel. I think we're waiting here for results of an investigation from the IDF, who says they cannot explain the fires that we saw following the strikes. They were going after a couple of Hamas leaders, and there's a thought that there may have been a depot of weapons or something nearby that created a greater blast, a greater explosion than they were planning for. Politically speaking, this is a horrible look as tanks now roll into the center of Rafah. Joe Biden said he had a red line on an invasion of Rafah, Romaine, and it looks like we're in the middle of one.
I'm going to ask you a question, Joe, that maybe you can't answer. But do you think this is going to be a material issue in the U.S. election?
It's a great question because, as you know, as a political mind yourself, geopolitics tends not to play into elections like this. But when you look at the reaction that we've seen from progressive Democrats, especially, who are calling this genocide in Gaza, the concern is not so much that they vote for Donald Trump, but they don't show up at all. And Joe Biden may not have won in 2020 if it were not for those votes. That's the concern for the campaign today.
All right. Joe Mathieu, co-host of Bloomberg's Balance of Power. You can catch him at the top of the hour right here on Bloomberg Television with deeper details here on the situation in Israel and the U.S. response to it. Meanwhile, we do have to go back to some breaking news. This involving American Airlines, the company updating its guidance for the second quarter, and that guidance is going down. The company cutting its second quarter adjusted EPS forecast to $1 to $1.15 a share. Previously, it had said that it was going to post $1.15 to $1.45 a share. So the low end of the previous range is now the top end of its current range. The company also says operating margin will only be about 8.5% to 10.5% for the second quarter. And as far as TRASM, they're looking at -5% to -6%. Previously, they were looking at -1% to -3% here. So something to keep an eye on, although those shares moved lower by about 4% here in after hours trading. Updated guidance to the downside for American Airlines. We're going to catch you up on some of the other things to keep an eye on over the next 24 hours in our What to Watch segment. That's coming up next here on The Close on Bloomberg.
South Africa's most important election since the end of apartheid focuses on infrastructure challenges, economic growth, and political fragmentation. Bloomberg's Jennifer Zabasaja reports live from key battlegrounds in Johannesburg, Cape Town, and Durban.
We think that South Africa is an exciting part of the world.
South Africa is a thriving and vibrant democracy.
There's a lot of expectation for the election.
Continuing coverage today on Bloomberg Television. Context changes everything.
One big thing investors will be watching tomorrow, South Africa's election. The country's ruling party has been successful in keeping the lights on for more than 50 days, but tomorrow's vote threatens to erode its outright majority for the first time. Bloomberg's Jen Zabajaja reports from Cape Town, the country's second largest city that's trying to wean itself off of the national electricity supplier.
South Africans have been used to this. Dinner by candlelight, pulling up to traffic lights that go dark, all due to frequent electricity cuts that have disrupted lives, impacting economic growth and prompting criticism from mining companies to retailers. Just last year, the power utility company Eskom could only keep the lights on for the equivalent of 82 days. But with an election on the horizon, South Africans have been enjoying a rare streak of uninterrupted electricity supply. Opposition parties have used the power crisis as fodder in the run-up to the poll, and now voters have become suspicious as to what lies behind the sudden recovery. Nearly two-thirds of South Africans said they'd consider not voting for the ruling ANC because of power cuts. Perhaps it's no surprise then that the government is trumpeting this winning streak. But the improvements have come at an environmental cost. The state has quadrupled the amount it spends on diesel to run emergency power generators. Still, though, the government insists the improvements are due to an increase in green power, including solar, through a public-private partnership. What they haven't said, though, is for how long the lights will stay on after the election.
And Jen Zabajaja there reporting from Cape Town on those South Africa elections. Among one of the big things that we'll be keeping an eye on that could potentially move the market, that election taking place May 29th, the results need to be announced within 7 days. Also keep an eye here in the U.S. We get the Fed's Beige Book. That's, of course, the anecdotal evidence of economic conditions across the 12 major districts. That comes out at 2 p.m. Washington time. And also keep an eye on BHP Group and the deadline for it to commit to Anglo-American PLC's merger proposal. That deadline just about 19 hours away from now, about 5 p.m. in London. Of course, that deal far from a sure thing. Meanwhile, back here in the U.S., we are going to get ExxonMobil's annual general meeting. Actually, a couple other meetings as well, including from Chevron and Meta. Something to keep an eye on here as those companies, particularly ExxonMobil, also looking to address some of their own M&A issues. And we get quite a few earnings as well. Earnings season continues to roll on here in the U.S. before the bell. We're going to get out of some names like Chewy, like Dick's Sporting Goods, as well as Abercrombie and Fitch. We actually do have a sit down with the Abercrombie and Fitch CEO tomorrow right here on this program, a closer look at the retail space. And after the bell, more earnings from the apparel space. American Eagle set to report, as is Capri, and we get some big tech earnings as well. That includes HP, and then it also includes Salesforce. One of the most acquisitive companies right out there right now has actually tamped that down quite a bit. A lot of questions right now about the sales trajectory for that company.